Hey, I appreciate you asking me. This is like, I feel sort of in very awesome company. This is like, you've had anybody who's anybody. Now you're like on the B list, but I feel like I'm on the top of the B list. So thank you.
You're at the top of every list, Jan. Come on,
Ah,
don't sell yourself short. Jan Freitag, thank you for joining me, sir.
appreciate you having me. This feels like I'm finally coming of age. I'm finally being invited to talk to you on camera. So thank you for having me.
You've been of age. You've been of age. Here's why I selfishly wanted you to come join. Because we got NYU coming up, right?
Yeah.
So on the eve of NYU, where I have, I don't know, 80 plus meetings, my team and I need you to get me smart so that I can sound intelligent. When everyone's like, Teague, what's the world look like out there? I can be like, well, let me say what Jan Freitag told me last week when we talked in person.
Which you can see online.
Right. And now we're just sharing this conversation with the industry, if not the world, because everyone cares. All right, so go. I want you tell me what world we're living in. A little bit of 6 months back, but of course 6 months ahead. Like, what are you seeing from current market trends and room demand and RevPAR growth and corporate travel and office and blah blah blah? I'll prime you, but get going.
So, a couple of big stories out there. GDP growth is still projected to be good. We just talked to Adam Sachs from Tourism Economics yesterday, who said, yeah, GDP growth is actually as strong or just like a basis point strong, 210 basis points stronger than last year. Good. But then you look at the world and we're just seeing sort of softness on the lower end, right? So the first quarter data came in and we're like, it's a little bit slower than what we had thought, right? RevPAR was positive, but barely. Now, there's an Easter shift, there was the President's Day, snowstorm that sort of took that week out. On the positive side, you had a football game in Las Vegas, and an Usher concert, and Taylor Swift was there and all that. So that helped the February data. But the way I would look at our data now is when you look at the total US numbers, you immediately have to unlayer it and say upper upscale luxury versus mid-scale economy. So room demand in the first 4 months, this is through April now, which just came out yesterday, demand for luxury hotels is up 4.5% for the first 4 months. Good, solid, healthy. Upper upscale up 2.3, good. Lower end economy down 5. And that is including, that is,
Yeah.
we're looking at the same time at, I don't know, like a 3% closure rate, 3 or 4% closure rate on economy. So we have on the demand side, luxury up 4.5, economy down 5. That's like a rough math, 10-point swing.
Yeah, that's big.
Which we normally never see when GDP is growing. So super interesting. So what's going on?
Right.
On the upper end, group we project to be healthy. If you listen to the first quarter earnings calls, Hilton, Hyatt, Marriott, Ryman, of course, a bunch of other players are like, yep, we're good. Group's steady. Even if it hasn't materialized, what's on our books looks really solid. When I talk to operators, as you do, you talk to revenue managers, and they're like, man, in the fourth quarter, small, like 70 peak, 100 peak groups, absolutely, they're there, and that's happening. Corporate transient, we're not back in the office fully, but we are where we are, and if you look at the TSA throughput data, Tuesday, Wednesday, Thursday, people are clearly flying.
Yeah.
So we expect that is sort of healthy news or okay news for corporate transient. And then the last stool of the three-legged stool of demand is leisure. And on the leisure side, on the high end, I mean, the wealth effect is real, right? The stock market does what it does. Your house is worth more. Multi-generational travel is happening. You feel really good about yourself, and you're going to continue to travel. So we were just in Chattanooga. Mitch Patel was nice enough to let us stay at the Edwin. There was a triathlon there. And I mean, A, people are really fit, but B, those bikes cost a lot of money, and people are out there doing what they're doing at that upper income level. The sort of asterisk to that is what happens this summer. Last summer, everybody went to Venice and Athens. Japan seems to be on a lot of people's minds. So if you look at the number of people flying to Japan for the first 4 months, it's higher than it was last year and higher than it was in 2019. Why is that? Because the dollar is so strong against the yen. So leisure, we also still feel pretty good about. Okay, so then the conversation turns to the lower end. So economy and mid-scale type properties. And there, man, we're over a year now. We're seeing room demand deceleration. And I was talking internally. I said, no, guys, it's going to be easier comps. It's going to be fine. And I've been wrong because it's just bad comps on top of bad comps. So that's not helpful. So then the question is, okay, what's going on? And what is probably going on is that the lower end of the income strata is being really squeezed. Their credit card debt is high. And if you have debt and you have to pay, 20% interest rates? If your credit score wasn't good, your interest rate goes way up. And if your credit card has a balance, that gets very expensive very quickly. CPI, Consumer Price Index, yeah, it's normalizing, but it's still pretty high. And I think if you look at the basket of things you like to have and things you have to have, car insurance, you have to have, up 49, call it 50% from 19. Milk, I just looked at this yesterday because I'm trying to build a chart that looks at these things that you have to have. Milk's up, whatever, 24% over 19. And then you look at what you want to have, which is your weekend trip. Well, if you only have so much paycheck to go, maybe you can't afford that. So then we're definitely seeing softness on the economy end, and it's bleeding into mid-scale. Room demand for mid-scale for the first 4 months is also down 2.2%. So that's not great. And it's going to be super interesting to see how the summer comes out. Now, because the lower end the performance is so poor, and really between upper mid-scale economy, that's 58% of all rooms, that drags down the national performance. So Amanda Hyde from STR, who runs STR, is going to, at the NYU Hotel Investment Conference, going to show the new STR CoStar forecast, which we haven't released yet, and we're knee-deep in sort of hand carving it. So I can't share it with you yet. But right now, our forecast is at 4.1%. It's not that. I can tell you that. We're taking a hatchet to that forecast. We're taking it way down. So heads up.
2%.
So
2%, I'm guessing, speculating.
I mean, somewhere. I think that's fair. So we're going to end up with a much slower growth on the RevPAR side. But again, I just want to urge everybody, when you look at the national number, you immediately need to sort of unlayer that and look at the upper end. Because when you listen to the REIT conference calls, if it's full service REITs, they feel pretty good about life, versus limited service hotels.
This tracks with what we've been seeing, right? I'm going to call it feet on the ground. We keep staying in touch with sort of 400 Motel 6s that we sold over the last 4 years, and they're all feeling they're probably hurting the most. You can just hear it in their voice and everything they're doing. And it's the expense creep up, but the revenues are down, so you can feel that. Moving up, the older sort of mid-scale assets are starting to feel. We're starting to see those declines, like just started this year, the last couple months. As you move up the food chain, the higher end hotels are doing just fine. Thank you for the Marriott ACs. Those assets, the new shiny hotels, they're doing just fine. Thank you very much. Some of them are up year over year, doing just fine. Thank you. And the group hotels are doing the best.
Yeah.
So feet on the ground, we're hearing it tracks with exactly what you're saying. So I feel good. I feel better that that we're seeing the data play this stuff out.
On the group side, I think the other piece that I think is super interesting is that some people are telling us, oh, we don't see it in our data. And I'm like, yeah, but because the booking window, I think, is still sort of compressed, you just have to trust that the group demand is going to come, because which CEO, other than association CEO, is going to say, oh, I would love for us to get together in 2027? People don't know what they're going to have for lunch next week. They're not going to make these long-term plans. So I think corporate events are going to be like in the quarter, for the quarter. In some instances, I'm hearing in the month, for the month. And part of that is, of course, that we're not back in the office, but that our CEO still has to build culture. And how do we do that? Oh, let's just all get together Tuesday night in Nashville, have a nice dinner, Wednesday morning training, Wednesday afternoon team building, everybody leaves. But those meetings can be organized with a very short lead time. And so I think we're going to continue to see healthy group demand, even though it's not on people's books yet. It's on the meeting planners' minds.
And how big are those groups? Those groups are like 10 to 100 people. Like they're not big 2,000 person.
Yeah, correct. Yeah. I mean, you need for those larger entities, you still have for those larger groups, I'm sorry, you still need, maybe it's next quarter, maybe it's 180 days from now. But I think the smaller, the sales stuff, the incentive stuff, yeah, it's a lot smaller.
All right, continue. And if I'm leading you, talk to me about extended stay. Where that was a bit of super hot market, and it definitely seems to be cooling. We're doing a bunch of extended stay Americas right now with Blackstone and Starwood, and we are seeing a softening there.
Yeah, I mean, so we break up the universe, upper end, lower end, and I just wrote an article about it for Channel News Now, that the demand percent change is either flat or like up 2 or something. It's really coming off these amazing growth rates, these amazing occupancies. If you remember, you don't want to remember, but if you remember April 2020, right, when there was no demand, right, the national occupancy was 24%, something crazy. But for the low end extended stay, it was 60+%. For the upper end extended stay, it was 50%. Half the rooms were full. And people were like, wow, I want a piece of that. That seems to be, if not recession proof, at least recession resistant. And I think a lot of people leaned into that. I think a lot of developers leaned into it. Obviously, a lot of the brands said, hey, this is where the developers are going. Let's lean into that and offer some more brands. But we're now absolutely, I think normalizing is the word, right? We're coming back to growth rates that are just a lot more normal, with 0, 1, 2, 3% growth rate on demand. But you have a lot more new supply, because that supply never really changed. Like the supply growth continued to roll because developers cared. So that's going to be a place to watch.
So I totally agree. And I think we're watching, but I think a lot of people are watching because a lot of our friends are developing in that mid-scale economy, extended stay space. And even in the upper scale economy, it's been really robust. And those have been the hotels that have performed the best in their portfolios, and that's what they're developing. And now we're really seeing the development in the economy and mid-scale extended stay. So is that a good place to be, or are you concerned about that?
I mean, the room demand numbers, they're not as robust as when you underwrote it, 2 years ago or so. What I'm worried about for that sector is that it really, the NOIs really only work when you have an extended stay customer. And what I'm afraid of is that people who used to play in the one night, every night, let's lease the room space, who are now wanting to be in the extended stay space, that they're like, oh, well, I don't have the occupancy. Well, my default is to just rent the room every night. And if you do that, that's fine. But then don't expect extended stay NOIs and GOP percentages, because that model breaks if you rent by the night. The point is that you rent for 7 or 14 or 30 days in a row.
Which sorry, but is why the dual brands worked really well when the like a Hampton and a Home 2 worked really well together, because you can really maximize the transient traveler in the Hampton, the extended stay customer in the home too, and really maximize both of those.
That was the hope, right? And I think that works when room demand is sort of firing on all cylinders. But if you have softness on the lower end, it is very easy to allow guests to stay for one night. And then suddenly your labor cost model is very different.
So does it not become low income housing, workforce housing at some point? These new extended stays that they're building?
I mean, that's, I think, the nice optionality, right, for the owner, right? If you build it as an extended stay type property, some of your customers may use it already as a housing alternative. And then you may just say, well, this 1 night, 2 nights, seven nights business is really complicated, but I already have the box, let me just make them all apartments. And I think that's for some owners to decide, yeah, that actually is a good idea. Or in some instances, you have the city come to you or the county and say, hey, maybe this project is a little bit long in the tooth, a little bit at the end of the economic life cycle. Maybe we take it over the lease or buy it from you, and then we make it, temporary housing for the unhoused or refugees or migrants. Then suddenly there's those work again.
Yeah, we've seen a lot of that happening, although it's slowing down as the money seems to be drying up.
Yeah, New York City still has 16,000 rooms. We track that. I get that question all the time about New York. It's still 16,000, I want to say 600 or so rooms that we track. So New York City is super interesting, right? Because you have 8,300 rooms being built as we speak, but you have 16,000 rooms being taken out of inventory. And then if you follow Jamie Lane from AirDNA, we used to have 23,000 units that were available for a night or two. He calls it less than 30. 20,000 of those are taken out. So you're like, wow, that's a lot of new rooms coming, but we have this double whammy of housing the homeless or refugees plus STR being banned. Interesting market, especially when you look at the pipeline, I don't know, 2-3 years out. There are only 1,200 rooms in planning right now. We used to have 10,000 rooms in construction, and now it's 1,200 in planning. So not all of those are actually going to happen. So New York City is a super interesting market to watch.
Yeah, thank you for bringing that up, because I was going to ask, but we agree. I mean, all of that, the Airbnb stuff, and now I'm not calling moratoriums, but, union construction and all the stuff happening. So people are really leaning into New York right now. And I think rightfully so.
It'll be super interesting to see what happens in 2026, right? When the union contracts comes up and they're like, hey, we helped you with the short-term rental ban. And hey, we helped you basically with banning new supply. What have you done for me lately? So that's going to be very interesting.
All right, give me other markets. Give me, I don't know, San Fran, DC, Nashville. Give me some other.
I mean, that's, Nashville right there. You saw the one Embassy just sold, for a really nice number. Host Hotels bought it from Starwood Capital. That one hotel, Embassy location is arguably A+ in town, so people always try to say, okay, so is this then true for all hotels in Nashville? That's what a broker would say. I can't say that. It's an A+ location, so it got a good value, a good valuation, I think. San Francisco, so Nashville has a lot of things going for it. You may have heard Oracle said that they're going to put their new global headquarters here from Austin, right? We're going to get this new stadium, so Taylor Swift doesn't have to play in the rain anymore because that can't happen. There's a lot of development on the East Bank, and there are, I think, 3 hotels planned in the Fallon complex as they're developing the East Bank. So there's a lot more activity going on there, and Nashville continues to just be really, really attractive on weekends. Weekends start on Thursday. There's still a lot of development there. So Nashville continues to have new influx of rooms. I think it's like 6% growth if you take all the number of rooms that are being built and divided by the number of rooms that are existing. 5% growth. So, that's well above the national average, of course.
Yeah.
But, Nashville so far has defied gravity. So it's going to be interesting to see. San Francisco, interesting because healthcare conference, the Morgan Stanley healthcare conference, had monster room rates. So the city isn't dead. There's still, if you have a meeting, you're still going for this specific conference. And AI companies are moving back into the office and coming back to downtown because leases in offices are so cheap. So then there's probably some draft that helps the hotel industry. No new supply to speak of. I want to say 200 rooms or something are being built, but we still have an overhang, right? The 3,000 room Hilton combo, that's being asset managed right now in receivership. That's going to be interesting to see who is going to take that on, at what price point. But I would never bet against New York. I would never bet against San Francisco. And I think, wasn't it Scott Trebilco from Blackstone basically made the argument at Hunter, right, when you interviewed him, that he thought that basically San Francisco was at the bottom.
Yeah, they feel the cities that sort of fell the farthest feel like they have bottomed out, right? They feel like they've bottomed out. I mean, DC, that's the other that I mentioned. We're seeing a lot of green shoots in DC. It feels like it's coming back, and it was pretty affected. I mean, the office people weren't coming back. There was no work. Everything was really down in those markets. So I don't know what your numbers show. And then the opposite end of that is sort of Miami and maybe even a Charleston or something. But the South Florida was at a peak, and it seems to be falling, maybe coming back a little bit. Same with the Charlestons and those kind of markets of the world. Is that what you're seeing?
Yeah, I mean, same, Tampa, Orlando, Phoenix had Super Bowl in it last year. So there's a weird Super Bowl comp, which is going to be interesting to see for Las Vegas next year. Yeah. I wouldn't bet against Las Vegas ever for this, and it could just be a zero. Like it could just be flat, that the growth next year is going to be exactly, or over this year is going to make the percent change zero. That would be wild because normally you always fall down. If you're a Super Bowl city, a Super Bowl host, the following year is just a rough year, as we see in Phoenix. And so we get calls about what about New Orleans? Can they sort of draft off this amazing Las Vegas performance? And I hate to say it, but New Orleans is not Las Vegas. We had normally the Saturday night of Super Bowl is the highest ADR night. For Las Vegas, it was actually Sunday night. People stayed in town. And
because it's Vegas.
For the market was $800 for the market. So for that Sunday night, it was it was legit high. So we feel, good about the markets that have the Super Bowl. It's hard to bet against Las Vegas. Las Vegas seems to just be this group destination that has sort of capitalizing on everything going right. Lots of group, lots of leisure, people staying over, not really corporate transient to speak of, but just a lot of events.
We're selling a couple of hotels in Vegas, to your point. And we, dare I say, far exceeded expectations on value and pricing. The bids that came in were really strong. Dare I say there was a bidding war. The buyers were very aggressive in Vegas for, nice hotels, but not the super special ones. Think of the one in Nashville. They're just really good hotels, and we had a bidding wars. And that's all Vegas. That's all Vegas.
Yeah, it's hard to sort of draw a line from that to anything else, right? You just have to say, look, this market is different. This market is arguably special. Yeah.
Yeah, that's all right. Give me another market, one more, and then we're going to move on.
Well, I'm just happy to see that Boston, Washington, Seattle, the three markets that had really been beat up with lack of people back in the office for such a long time, are seeing a pretty healthy year-to-date performance. So that's really just good to see. I think that speaks to group coming back, not mostly, some of it, corporate transient coming back, and obviously some leisure.
All right, I lied. One more, Atlanta. What do you see selfishly? What do you see for Atlanta?
Well, first 4 months, down, what is that, 4.5 or so? I think this is because such a heavy group market, so easy to get to that a lot of convention and association events are happening there. And if you have one or two rotate out, as they do, then your year looks a little weak, I guess. But I never bet against Atlanta.
So let me get a little more nuanced in Atlanta. Submarkets, okay? So downtown, which is group, is doing fine. Thank you very much. Right. Brand new Signia Hotel. Downtown is doing just fine. Thank you. Midtown is doing great. Midtown is doing really well. It has held really strong. The office community there, tech office is back. And the new hotels there's a lot of new demand generators that have been built. There's a lot of new hotels that have been built, and they're doing great. Thank you very much. Buckhead, soft. And Buckhead was an amazing market. It is soft. They're the opposite. There have not been any real new demand generators built in Buckhead. So soft. And then the softest go out to Perimeter, which is a suburban office market, is really soft. It is really, really, really soft. There's and conversely, we just sold one. We probably got 4 or 5 on the market in that market because people are betting again all the capital problems that you're having, and they don't think they can hold on any longer. And we're probably selling most of those assets for the banks. So you could say Atlanta, but I just named 4 very different submarkets within the same market.
Yeah, and I think that is true, for most markets, right? That there are in some of the East Coast markets, the downtown core CBD, where people have to be back in the office or you get fired, or where it's not 2-3 or 3-2, it's 4-1.
Yes.
I think in those markets, you also then see the upper upscale or even limited service hotels around those offices do well. But you talk about the suburbs where you have class B office space, and people are saying, look, I don't really like it. Like, it's not worth for me to drive an hour to this drab space. I'd rather go to the WeWork, to the Starbucks down the street, where it's a little bit more energetic, or I just work from home. And I think those types of properties on the office side, that's tough. And then if you have a hotel that's banking on that office park occupancy, that's also really, really hard.
Yeah, keep diving into office. What are you seeing that's working? Urban, CBD, suburban?
Yeah, so I have a couple of slides from we have a national director of office analytics from Mobley. He sits in Boston, and he does really, really interesting webinars. One of his arguments is that he collected data from all sorts of companies that look at mobility. So we've all heard about the Castle swipe system, but you can look at MTA, New York City, how many people are taking the subway or the bus. There's Pacer AI, mobility that track your cell phone. And those numbers haven't really moved. I mean, if you look at the slide, they're sort of in this band. It's like it's come back up from 2020, but now it's sort of, between 60 or 70% of 2020. So you could argue on the office side, it is what it is, and for a lot of people, we're seeing 3-2 as being sort of the new way that people come to the office. You're home Monday, Friday. And I was talking to a private equity guy in New York who said, look, if they make me travel on a Monday or Thursday, Friday, there's going to be an armed riot here. We're going to travel when we are in the office because we've arranged our life around being home and going to the vet or picking up the kids or whatever on Monday, Friday. So there's going to be this interesting dynamic, I think, where we're going to continue to see in 2024 that transient travel is going to be crushed into this Tuesday, Wednesday, Thursday night. But then you have healthy group demand, as we just talked about. So isn't it possible that on the rate side, the upper end, we're actually sort of underestimating pricing power because people are just going to be, a 5-day travel week is going to be a 3-day travel week. I don't know that, but that's sort of what I'm wondering about.
That's fascinating. I'm gonna watch that. I think you might be right there. So I mean, and then hopefully on the weekends we keep talking about this bleisure. I don't know what the stats show, but I'm gonna travel. Then I'm gonna stay over.
Yeah, so I think that was a thing, absolutely.
Yep.
And in specific markets, I think that might be a thing. Orlando, Vegas, Nashville.
Yep.
But I don't know that we're going to continue to see that because I think everything is normalizing and people's pocketbooks on the lower end are definitely strained. So they may just say, look, the company pays for it Wednesday, Thursday, and then on Friday I should pay myself. You know what? I'm just going to fly back home.
All right, I want to talk transactions. So I want to talk interest rates, transactions, and then sort of what you see for the future. I'm guessing interest rates are higher for longer, unless you're telling me something different.
Well, I mean, this is your sandbox. So Q1 transaction volume down 50% from Q1 a year ago. Everybody I talked to, and you talked to the same as I talked to, so I think we're saying the same thing. Everybody's thinking, hey, second half of the year, we're kind of done waiting. This money is burning a hole in our pocket. We got to deploy it or we got to give it back, and we don't want to do that. So we're going to act. And I think interest rates, if we know nothing about when they're going to get cut, but I think we know that they're going to stay at this level or lower, right? So they're not going to go up. I think that's sort of the common wisdom at this point. And so then, okay, can I make a deal today and then refinance into a lower interest rate environment 6 months from now, 8 months from now? That I think is sort of getting a lot of people interested. On the other side, and I hope you have some color commentary on this, are the pips, right? The brands are saying, look, if we say the brand standard is X, for 5 years, you've said, oh, I can't, I won't, I don't. No, let's go, put the money back in so that this property lives up to the brand standard. And some owners may just say, I'm tapped out, right? I mean, how do you see this?
No, that's exactly what's happening right now. There's too much pressure. So the irony, in my opinion, the brands were really nice over the last couple of years. Hey, we can't do anything. We can't. And the irony is, just my opinion, I think they should have done it because they weren't full. But they had money, ironically. So they should have renovated then. Now the pressure is on. The pressure is here, and there's not enough cash flow to pay for the stuff, and there's not enough gap in equity for them to come renovate these assets that probably need to be renovated. So there's big fights right now, really big conversations. The brands are holding strong right now. You got to renovate, you got to renovate. But when you're going to hand the keys back to the bank,
or is the brand really going to say, and therefore we're going to pull the flag?
Right.
Net unit growth rules more than anything.
Right.
NUG is the number. I mean, you and I love talking about RevPAR and everything. That's secondary to net unit growth, and I don't think brands are really willing to say, hey, we're going to kick you out of our system. I think part of it is why we have this brand proliferation, because they're like, well, you can't be that, but you could be that, right? With as much small. Yeah.
And we just keep seeing, what was it 10,000 a key PIP is now 20. What it was 20 is now 40. Wow. Oh, big time. Big time. I don't know. I get it from the brand side as well. I really do. But you're really just trying to keep up. I do think way back when you did the PIP to actually improve and you could raise your rates. And today that's not proving as much. You're just kind of keeping up with the Joneses and with the competition around you. You just try not to lose market share. You're not really raising rates.
Which is why it's so interesting. There's so limited new supply coming in, right? Yep. And so the properties that are opening, that are the new, shiny penny, definitely have an advantage because everything is new. There aren't bathtubs anymore. It's all stand-up showers. It's new rooftops, it's new F&B concepts, and all of that probably helps then the owner to say, okay, now I can be the rate leader in the market because everybody around me is 5 years older, than when the pandemic started, and they haven't updated.
Give me your development data. You've got it. So what does the new construction look like?
So I have said this, we have said this for, I think, the last 9 quarters. The number of rooms in construction has been sort of in this 150,000 to 160,000 band. It hasn't moved. What that means to me is that the projects that are opening, and some are opening, they're getting backfilled by some projects that are breaking ground. But it's not this, oh, nobody's building, or, oh, everybody's building. It's this sort of slow and steady bandwidth. Supply growth, first 4 months of this year, has been 0.6%. 0.6%. The long run average is like 1.7. Now, 0.6 is 3 times as much as it was last year today. It was 0.2. So Yes, we're taking some out of inventory. You know, the 16,000 rooms in New York matter. A lot of the economy stuff falls out. That matters. But it's just fascinating to see in this environment where GDP growth is healthy and where the interest rates, yeah, are elevated. But this is really the time. If you have the wherewithal to break ground now, you're going to open a year and a half, 2 years from now. And man, there's nothing around you that's new. But it's just really, really hard to make that work and get that construction loan from the bank, as you know. So the number that a lot of people pay attention to is in the planning phase. We have 330,000 rooms in planning. That's up 40%. So there are a lot of people who say, I have the land, I have the brand, I have the plan, and now I go to the bank and they're like, well, construction loan is, I don't know, I'm making up a number, SOFR plus 1,000. I don't know, SOFR plus 500. You know, it's like, it's very, very expensive, right? And to make that and to say, okay, now I want to break ground, given my construction is so expensive, that's just really hard. So that number is ballooning. The planning number is ballooning. And the question is, will all of those happen? And if they happen, it's probably going to be 3 to 4 years. Or will some of those just fall out? And will some owners just say, look, multifamily, it's kind of the same, you know, building extended stay or multifamily, let me just build a multifamily, you know, and maybe sell that.
That's what we're seeing. We joke, we call it, oh, we're going back to the design phase, right? That's because we don't want to come out of the planning phase. So we're just going to keep kicking that can.
Yeah.
All right. So wrapping up. Thank you, Jan. This is great. Thank you. But give me your future predictions. Tell me what we missed or what I haven't asked. Give me what your crystal ball look like.
I'm a glass half full guy no matter what. That's just the hospitality personality. I don't know. It's all. So what I'm saying is, unlayer the data immediately. When you see it, make sure you understand what's going on the upper end, what's going on the lower end. We feel really good about group corporate transient. We feel pretty good about leisure. We have concerns about the lower end, and there you really have to monitor your costs. You know, you really have to make sure you understand what your cost centers are and how you can continue to keep that under control in order for you to make your returns. It's going to be slow and steady, right? The American economy is going to continue to grow. CPI is going to continue to moderate. Like all of those are really, really helpful tailwinds. And we have almost no new supply. You know, so as an existing operator, you should feel really good about it. But then there's just, you know, we live in an uncertain world. And unfortunately, you know, there are a lot of uncertainties, and we talked about it in the pre-call. So we feel good, but we don't feel great, I guess, if that's to sort of summarize it.
I think we would echo that. Again, with the exception of all the black swans that are out there, geopolitics and the like. But right now we've been cruising through those, knock on wood. Here's hoping we can continue to do that. Thank you. Final question. Who's going to win the NBA? I know you're an NBA guy. That's why we're talking this. Who's going to win the NBA championship?
I know my Boston fans hate me saying it, but this is Dallas all the way, man.
See, I think Minnesota is going to win. I think Ant-Man's taking it.
I'm with Luka.
You're going Luka, of course.
I'm going Luka.
Of course you.
I love.
Of course you do.
And he's Dirk Nowitzki sort of legacy, so it's like it's the German in me who's like, oh, when in doubt, Dallas. You know.
Yeah. Don't bet against that guy, right? Put the ball in his hand at the end of the game. Don't bet against him.
Exactly. If you have tickets, by the way, I'm in the market. So.
And I'm looking for a friend. Thank you. Deal. Yeah. Caught you. All right. I wrote you down for the Mavericks. Did you see our Hawks win the draft lottery?
Yay, you.
In a year where there's no one, that's fine. We're not going negative. We're staying positive. That's right.
Exactly right.
We're going to pick Alex Sarr, the French 7'1" French kid. Going to change the whole dynamic of the.
Absolutely. Yes. And then I'm going to call you.
Deal. Come on. Mitt and I would love to have you.
Perfect.
So, Jan, thank you. You're a great friend. I feel much smarter right now, fully prepared, headed into it.
Much smarter. Clearly, I think it shows.
You're hysterical. All right. Mom? I got to run. I got to go. Mom's calling.
Bye.